guest speaker lined up here for you. You guys have, many of you have heard him speak before. If he was not a senior vice president for the Capital Group, I think he could probably do pretty good on the stand-up circuit. And so that's Damian Eckstein. He's been one of our strategic partners for, you know, I've worked with American funds, I'm going to say at least 25 years of my 33-year career in this industry. And many of you are participating in the American funds. It's a core foundational holding for you. And so we are excited about American funds. They do things the right way and they make us look good. And so their performance is extremely consistent, and it's been great having them as a strategic partner. So with that, with no further ado, I'm going to go ahead and open it up to Damian. And then afterwards, I'm going to introduce two of our newest team members here at the Advanced Planning Wealth Management Group with Raymond James. So I'm excited to introduce those guys to you. But until then, I'm going to turn it over to Damian.
Rod, thanks so much for allowing me to be here. And for those of you listening in or watching, I guess, you know, there's very few people I'm putting a suit and tie on for on a Friday. Rod, you know, we appreciate your partnership. So, you know, it's nice to be back, and you know, for the first installment of Money Talks for the year. And you know, what I'd like to do is talk about our view. And one of the nice things about Capital Group and the American funds is we take a long-term perspective to everything. Our investment professionals are paid 1, 3, 5, and 8 rolling periods, but 75% of their compensation is on the 5 and 8. So I say that because it's important to understand that, you know, when I say outlook 2021, it's not what we think happens in the next 6 days or 6 minutes or 6 months. It really is, you know, taking a snapshot of where we sit today and looking out over a cycle. What opportunities do we see? And you know, I'd be remiss if I didn't thank everybody on this call. I know many of you own American funds, so the trust you have in us, it doesn't go unnoticed. We appreciate that, and we appreciate the trust Rod has in us as well. You know, we're coming off what was, quite honestly, the craziest year of my lifetime. Not only from a business perspective, as I sit here 11 months in, doing all of my meetings virtually in my, I used to lovingly say this was my office. Now I call it my jail cell. And I can't wait to the day, whether masked or unmasked, that we're doing these face to face again. But you know, if you had told me prior to the beginning of the year that we were going to have a global pandemic, the U.S. was going to shut down, as was most of the world, and all of the crazy things that we saw, and then asked me to determine, you know, just off the cuff what the stock market would do, I would have put a number far below the number that was provided to us last year. You know, in spite of everything, the economy kept on keeping on, especially those parts of the economy that were easy to transition to a virtual world. So we're going to talk about that as we look. You know, let me do this. Let me share my screen to make sure it works correctly. So Rod, are you able to see the outlook 2021? Yeah. Perfect. Yeah. And to my opening comments, long-term perspective on markets and economies. And what I really want to do is threefold in probably the next 20 minutes or so. First and foremost, I want to talk a bit about the macroeconomics that we're seeing and what that means from a U.S. stock market perspective, which is probably most important on the mind of, at least from an investment perspective, those of you on this call. Secondarily, I'm going to talk about what we're seeing from an international perspective. You'll see a little bit in that macro and what we think that means from a stock market perspective. And then finally, a little bit about interest rates and what we think happens in the bond world, or you know, if you're thinking personally, what that means from a any borrowing cost, but a home mortgage or car loan and all of that really plays into what the Fed is doing today and what we think they do over the next few years. So that's my game plan. When we're through, I know Rod's going to introduce some new teammates that he has. And then I think we're going to have some Q&A time. So I always call that the period of time that I'm going to make up answers to the questions you have. And I'm going to try and do it as seamless as possible so no one knows whether it's the real answer or me just making up an answer. No, I joke. I'll try my darnest to answer the questions in an appropriate manner. So let me start here from a big picture perspective. What you see are the estimates for real GDP growth from a global perspective, not our numbers, but the International Monetary Fund, the IMF. So you could see in 2020, the US real GDP dropped about 4.3%, and their expectation is a growth of 3.1% in 2021. Here in the middle, you had a bigger drop in the Eurozone, but an estimated growth of 5.2%. Maybe I'll just use my pen here. You see that right there, growth of 5.2% this year, 2021. And in the emerging markets, they dropped a little less. We could talk about that in a moment. And then the expectation of about a 6% growth in 2021. Now, inevitably, when I show this, and if I had the mics open right now and I asked if there were any questions, the comment I get is, wow, Europe seems to be, on the precipice of some real good growth, yet they've had as much, if not more, struggles than us in the United States. And that is absolutely true. But Europe generates about 50% of its GDP from the emerging markets. And quite frankly, the emerging markets fell less and are growing faster because they dealt with COVID easier. They had a better COVID response. Now, I do not want to suggest to anyone in this line that the way they did it would be tolerable here in the United States with massive lockups where, even when we were quote unquote locked down, about 50% of workplaces were still open. If you look at parts of China, they were 95% of people were in at all times. And in Wuhan, I think it was a 72-day or 73-day lockdown. There's contact tracing that's an absolute must. So to go in buildings, you have to tap your iPhone and such so that, if somebody does get sick, they can trace everyone around them and make sure they quarantine. But because of that, they handled COVID a bit better and as an offshoot have grown a bit more out of it and really give us a roadmap to what we think we'll see. But nonetheless, from a global perspective, we see growth. And at the same time, central banks continue to support asset prices. From a global perspective, rates are about zero. And you saw that happen in quick order here in the United States. Almost as soon as the pandemic started, we went to and the Fed put us at at least on the short-term rates at zero. And we had the fastest drop in stock market history. So we fell 34%. It was the fastest 30+% drop in stock market history in under a month. But as the Fed and globally interest rates went close to zero, the market responded. And within 128 days, and to put perspective in, and you can see it over here, the 07 to 09 drop, this sort of dark color, it took 1,426 days to get back to where we were. In the 2002 drop, it took 1,872 days. Now, both of those drops were longer and a bit more steep, but far longer time to recovery than we had here in the last one. And part of it was the speed with which we had COVID relief packages. And we'll talk more about those later on. And then the speed with which we went to zero interest rates, and that low interest rates drove stock market. Now, it continues to create what we would call a Goldilocks scenario from a stock market perspective. I lovingly call this a TINA market. And somebody goes, well, what the heck is a TINA market? It's short for there is no alternative, TINA. Quite frankly, where we sit today with really low interest rates, as an investor, you're being forced by the Fed, right, wrong, or indifferent, and there's some long-term ramifications, but in the near term, the marketplace is saying if you stay in really conservative investments, you get zero return, and investors have moved further and further out the risk spectrum. And that's driven asset prices. You could see it in Bitcoin, you could see it in gold, you could see it in housing. If anyone's looked at what's happened here, if you're local to Orange County, like we are today, like I am today, houses have been going up at record clip. In November, the Case-Shiller housing market indicator went up 9.5%, its biggest monthly gain. And then stock markets obviously have recovered off the bottom, but more importantly, we're at all-time highs there as well and continue to go up. So, again, from a macroeconomic perspective, we at the Capital Group think you're in a market environment where things just continue to go up. Now, the question, and I think this is the important one as an investor, is how do I invest within that? And I want to give you a framework that I think is really important. I think this page is really important. And if you think about COVID as a tsunami followed by a big wave, right? Three things happened, or three type of companies. Some companies sunk under or drowned in that wave, right? And they're never coming back. Some swam, and if you swim in a big wave, it's not like you're really swimming in a pool where you're graceful and such. No, you're like bobbing your head and just trying to stay above water. Right? There's some companies that did that. We'll talk about those in a minute. And then finally, there's some, when you have that big wave, that are just crazy and they get up on their surfboard and they surf and they get pushed ahead. And what we did with this graph, if you look at the line right here, we're just simply saying companies above are in secular growth. So they're companies that are growing faster. Companies below, like energy, retail, home improvement, staples, they're companies in secular decline, a little less important in the investment universe. But companies to the right of this line over here were helped by COVID. Home improvement and staple companies were obviously helped, but more importantly, technology and healthcare. We'll talk about that in a moment. Over here on the left were companies that were hurt by COVID. So if you think about the companies that really did well because of COVID, it was these top two, healthcare and technology. And think about it, right? Healthcare, everybody wants to fix the problem. So you either want a vaccination, which we got in record time, or therapeutics. Those stocks did really well. On top of it, anything that helped you do what you do from home, whether it's shopping or Zoom like we're on right now, those technologies fared very, very well. And if you look, the Russell 1000 growth, so growth index, much like Growth Fund of America, the Russell 1000 growth was up 38.49% last year, 38.5%. The Russell 1000 value, so more of the dividend companies, sort of the big blue chip of the world, they were up only 2.8%. Those two indices go back to the mid 70s, so 45 years, and that almost 36% gap between them is the widest we've ever seen. So what I want to focus on for a moment is right up here in what we'll call pent-up demand area: travel, food service, entertainment. I do not want to suggest that any of you call Rod and try and buy these spaces in and of your own, on your own. But with that said, the baby was thrown out with the bathwater, and there are some really great companies in that part of the world that got pushed down, that they're just trying to stay alive. And our men and women are doing research to find out, okay, we have a view that COVID, because of vaccination, the second half of this year starts to look a lot more normal. And that you'll take this pent up demand that you see starts to change into people actually taking advantage of it. But what we're trying to do is stress test companies in this world and say, can they live in the current environment for 12 or 18 more months? And those ones, the winners of that, the best companies, we think, have been hurt too much by COVID and represent a great opportunity. Because if you could think back, we had the Spanish flu in 1919, and it was followed by maybe one of the most impressive stock market periods in our history, the 20s, the roaring 20s. People were stuck at home because of that Spanish flu. When it ended, there was a lot of pent up demand and they wanted to get out and enjoy life. I'm a Golden State Warrior fan. Steph Curry's looking like an MVP again this year. So for those Laker fans out there, probably still have us this time. I see Rod. Lakers, they won it all last year. But, this time of year, my son, Dylan, he's 12, just turned 12, and I would probably have taken a flight up to the Bay Area. What's funny? On the other side of this desk, and I can't show it right now, is a Steph Curry signed jersey. Rod's holding up his Magic Johnson jersey, but I got a Steph jersey on the other side of this. Let's be honest, two great ballers. But Dylan and I would normally get on a plane, go up to the Bay, get a hotel for a couple nights, go to a game, have a couple nice dinners because my 12-year-old likes to eat sophisticated foods. And we would have spent $2,000 or $3,000 or $4,000, dollars. We can't right now. So it just goes into savings. Average household wealth in the United States is up 18% year over year. Now, I don't want to suggest that this hasn't hurt a lot of people, 10% unemployment, but folks that had the flexibility to work online, folks that had investments like those of us on the phone have, seen our wealth go up at a time where we haven't been able to enjoy it. So you get that pent up demand that we think in the second half of this year, as more people are vaccinated, as more people get COVID like I did and get to the other side of it, we think you get a robust market and a real opportunity for some of those stocks that have, that are over here in this hurt by COVID, but secular growth that are maybe underpriced to go up. So all I'm talking about from the US is we think there's opportunity, but we want to own more than just Facebook, Amazon, Google, Netflix, Apple. Great companies, but that Russell 1000 I talked about earlier now is 40% in just those 5 stocks. And we think there's opportunity that might be being missed by the rest of the market that we're taking advantage of inside of our funds that ultimately will help you and all of our investors have better outcomes. So from a US perspective, we think there's growth. We want to make sure that you're a bit more balanced than just the indices, which overown maybe a handful of technology and healthcare companies. Now let me pivot to international. And sometimes I feel like I'm a broken record because international stocks have been cheaper than their US counterparts for the better part of 5 or 6 years. But even though we all can see it, it hasn't mattered. US stocks have won. We believe that there's a real opportunity from an international perspective right now. So let me show you one graph that I think is really important. So this graph is simply showing the US dollar against its counterparts. In the red shaded areas, like you saw in 2003 to 2010, what we see here is a dollar that's in decline against other currencies. And if you remember back in 2010, there were articles in the Wall Street Journal about actors and actresses that only wanted to be paid in euros because the dollar kept declining and it just seemed the right thing to do. Those actors and actresses were real visionaries because they called the bottom of the move. When they were getting paid in all euros, it would have been the time to get paid in dollars because the dollar was about to go up in value. From 2011 to 2020, we had, and you can see here the trajectory as I draw it, a pretty strong dollar. Now, why is that important? From 03 to 2010, when you had a weak dollar, international stocks beat their US counterparts by about 5.5% a year. And then that was followed by a stronger dollar from 11 to 20, where US stocks beat their international counterparts by 9% a year. We think that you're going into a period, and you see it started right here at the bottom, more recently, where the dollar weakened. And we think the dollar, and let me erase that because I made that ugly. We think the dollar is going to weaken for a couple reasons. One, and this is not to be political, so I will start it that way, but both sides of the aisle have spent a lot of money. And rightfully so, $3.5 billion in COVID relief already. Last year, and let's be honest with one another, it's money that we're printing. It's not money that we have saved, so we're making more bonds. And they talked about another $1.9 trillion of COVID relief, and there's talk about Senate Republicans were visiting with Biden this week to talk about an infrastructure deal that could top $1 trillion. So you're talking about maybe another $3 trillion of money that we're going to have to pay back in the future. That has consequences. Because of that, the extra yield that an investor gets buying U.S. bonds relative to German bonds or Japan bonds has disintegrated. So now we have sort of two things going at the same time. You have the U.S. spending more money, which puts pressure on the dollar, and you have less countries buying our debt. There's less reason for somebody in Germany or in Japan, big buyers of U.S. debt historically, to buy ours. They're actually equally as well off buying their own. All of that together puts pressure on the dollar. We saw that towards the end of last year. We think it will continue. Now, to make this really simple, why does that all matter from an investment perspective? If I am here in the United States and I want to buy a stock in Europe, the first thing I have to do is sell my dollars and buy euros. Now I take my euros, I go buy that stock, and if it does exactly what I think, and more often than not I'm wrong, but let's just say I'm right in this case, and the stock goes up 25%, and this is true. Whenever a stock goes up a lot, the first thing I do is I tell my wife, because I want her to think, wow, Damian, you're so smart, you're such a great guy. So the stock goes up 25%. I tell my wife, and then I sell the stock. Now, in order to put that money in my bank account, I have to now take the dollars or the euros and put them back into dollars. Well, if the dollar went up in this hypothetical scenario 30% over that period of time, well, I just turned a 25% movement in the stock on a positive side after the drop in the currency or the growth of the US dollar and my currency loss. I turned a 25% gain into a 5% loss. That's a really simplistic view of it, but that's the way it works. So when you have a weaker dollar, it creates a tailwind to international investing. So we've had a headwind, so it was harder to invest international and reap rewards. Now we think you're going into a period where that's not the case. Now, again, I'm going to pause and tell you, this is not I'm not saying this for you to go, you know what? I'm going to call Rod and tell him, Damian said, sell all my US and buy international. No, not the case. But what I will tell you is if you look at institutional models, so pension plans, things that we develop or Raymond James develops, and broad-based models, probably 20 to 30% international exposure. Not probably, that's where those models are. The average retail client, like you, me, and the rest of our friends, is closer to about 10%. And honestly, being underweight has been really good for us because the US won by 9% a year. The reason I'm bringing this up today is if you find yourself really underweight, again, I have the easy job. I could talk big picture, but if you're really underweight, maybe there's a conversation to have with Rod and say, hey, does it make sense for us to add more? In some cases, it doesn't. Rod has the more difficult job, which is to understand the psyche of the investor, right? How much risk can you take? How much volatility? How much movement in your portfolio? For some of you, you could own more international. You have the intestinal fortitude. But for others, that volatility that comes along with international might be too much. So, that's why Rod builds the portfolios the way he does. But for some of you, he may talk about owning a little bit more global or international. And this is part of the reason that there is an opportunity set there. Okay, last thing I want to talk about, and I'm coming right up on that 20 minutes I promised, is interest rates. Interest rates are really low. The 10-year trade's about 1.1%. If you've refinanced a house anytime in the last year, you've seen rates at historic lows. We think that rates stay low for a really long time, and here's the reason. There's two big risks we see to this market. Risk one is that COVID has a variant that the vaccine doesn't work and causes people to stay in longer. That's the first. Now, I've listened to a lot of really smart people from an epidemiology perspective that talk to us, and this is a single strand virus, so the probability of that happening is less than a multi-strand virus, and I'm not quite sure what that all means, but they were coming from smart people, so I just smiled. Our base case is not. Our base case is that towards the second half of this year, most people are vaccinated, and life starts to look a little bit more normal. But there is a risk that you see a variant, so that the risk isn't zero, so we think about it. The second risk, and more to the topic of fixed income, is that rates go up a lot. because part of the reason that stocks continue to go up, that real estate continues to go up, is we have really low rates. Because of that, the Fed has said that at least through 2023, they're going to peg short rates at 0. And on top of it, they're sitting with a big cannon of money willing to buy to lower rates if they got much higher than where they are right now. So because of all of that, we think you're going to see rates stay really low for really long. Now, what does that mean as a fixed income investor? We think there's 4 things that bonds can do for your portfolio. The first 2 are very similar: capital preservation and diversification from equity. The other 2 are income and inflation protection if you buy TIPS. We think it's really paramount that when you think about fixed income, you think about it through the lens of what is the role I'm trying to serve. There's a lot of, if you want bonds that are paying 5 or 6%, they're out there, but they're a lot riskier than those same bonds were. To get 5% 10, 15 years ago, you only had to buy a CD. Now you have to buy a high yield bond. There's a lot more risk in a high yield bond than a CD. If you're looking for income, you just have to be cautious to understand that if the income is larger, it comes with more equity-like risk. Not bad, just something to understand. We really think that the core part of a portfolio right now from a fixed income perspective should focus on capital preservation and diversification. And the reason we say that is we want you to take your risk on the equity side of the ledger. We think there's better opportunity on the equity side. And if everybody has a certain level of risk they're willing to take, we want to take the vast majority of that on the equity side and then own higher quality bonds, not because we think they're going to be really advantageous to your return, but they're like the handle by the door, the oh crap handle, right? Like just something to hold on to, that ballast of the portfolio if we get a real gyration in the market. So that's really the focus. And we think, in that you're giving up some yield, and quite frankly, yield's just not as prevalent out there today. And what we're finding is more and more investors are looking at their portfolio as a whole and saying, okay, I'm going to have to take some of my income by just selling off the portfolio. So, the view of a distribution of the portfolio. And having more of a stock bent, and instead of just getting all of your yield off of bonds, selling some of the securities off over time, getting a better return that way than just simply looking at bonds as the only income driver. And we think that's going to be something that folks have to look at for a period of time now, or a period of time going forward, just simply because the yields out there are just not as attractive as they were in the past. They'll get there again, but for the next few years, we think rates are going to stay low and want people to invest from that perspective. So maybe if I just in review from a U.S. perspective or just a global macro perspective, we think we're in a Goldilocks scenario where rates are low and it drives asset prices higher. In the U.S., we just want to make sure you think about things from a balanced perspective, and money's not solely in Facebook and Amazon and Apple and Netflix, Google, Tesla. If we did this last week, I would have added GameStop into that mix, but now no one wants to hold that anymore. But that handful of stocks, we want people to be a little bit more diversified than that. We do believe, secondarily, that there's an opportunity international, again, from a balanced perspective. There's nothing that makes us jump up and down on our desk and say, wow, this is so cheap, you have to look at this because it's the opportunity of a lifetime. No, this is a market where you want to stay really well balanced, stick to your plan. And if you find that there's an opportunity on the margin to make some changes, that's where we think you should. And then from a fixed income perspective, we just see rates staying really low, and a Fed that has a long an eye from a long-term perspective at driving asset prices through by keeping rates low. So I'll end where I started and say thank you. Appreciate not only the continued trust in the American funds, but also the time you set aside for us today. So with that, Rod, I'll be quiet and pass it back to you, my friend.
Am I off mute? Okay, very good. Good. Let's give a virtual hand to Damian Eckstein. You did great, brother.
Thank you.
As per usual. Just a quick announcement. Damian will be appearing at least quarterly. He's going to have a quarterly report for us via Zoom. So he's locked in quarterly. And hopefully, once the pandemic is over and we're out moving about and socializing again, we will get back to our in-person luncheons at least once a year with Damian. Okay? So we're looking forward to that as well. At this time, we're going to open it up for questions. There was a lot of good information. It was very concise, and it sounds like American Funds Capital Group, they're very optimistic about the economy going forward with a lot, with good reasons. And so is Raymond James, and I'll be going over Raymond James' outlook next month, okay? Damian, you had mentioned that the Capital Group sees a lot of potential, growth potential in international, and that the valuations of international companies, those stocks, are better valuations than what we have here in the U.S.
Yes.
What specific regions does American Fund Capital Group feel offer the best potential?
You know, so that's a great question, Rod. And we never think of things from a top-down perspective and just simply say, hey, this is the best region. What I would tell you is that all of the ideas percolate from the bottom up. So we do research globally and find it from a stock by stock perspective. With that said, I just saw something interesting. Euro Pacific, which is one of our international funds, has the lowest cash balance that it's had in 37 years. So the men and women, what that tells me is the men and women that run that fund are finding a lot of opportunity. To say that the lowest cash balance, and I think it's in the 2.5. So we still have a lot of cash on hand. Don't worry about that. But the lowest we've had, it signifies that we're finding opportunities. Secondarily, the highest weighting in the emerging markets that we've had over that same time frame. It's about a third of the fund. So everything is sort of bubbles from the bottom up. But then I can look at it from an overall and say we're finding a lot of value because we have a low cash position. And that's coming off a high cash position because we built cash in February and March when the dislocation happened, and then used that to buy stocks we thought got too cheap. So we've put a lot of cash to work, and that we own a little bit more emerging markets than normal, which again just signifies that we're finding a lot of opportunity in those areas to put money to work.
Okay, excellent. Okay. Let's see, which sectors, Damian, does American Fund Capital Group, which sectors do they feel show the most promise here in the U.S.? I know you had mentioned consumer discretionary.
Yeah, we still feel that there's names in the technology space, cloud computing, things like that still have a lot of way to go from here. That aren't that small handful that drove most of the return. There's a belief that the companies in the travel and food service, entertainment, not all of them, like we don't blankly like the sector, but there are companies within that we think it went down too much. Like you mentioned with AT&T, there's companies that just took too much of a brunt because of COVID and haven't fully recovered. Where the recovery was driven by just a handful of companies that were most well served in that idea of that riding the wave. But even financials, like there's some parts of the financial market hit very hard. Financials was the second worst performing sector last year, only to energy. But some of it is just memory, right? Like the last time the market went down, financials were so bad, so people perceived financials to be a bad part of the market, and when the market went down, they freaked out. But financials are in a lot better shape from a balance sheet perspective today than they were in 2008. Going back to that conversation about retail and real estate, residential real estate. So, you know, there are names throughout really all market cycles that, or all market sectors that we think are ripe and have some opportunity. But you know, still, if I was to look at the portfolio, there's still good holdings in technology that probably just a little less household names. Maybe the backbone to some of the companies that we all know, because the companies we all know have already worked, but sometimes the infrastructure to make those companies as great as they are less known, and it's that second and third derivative of an investment idea that we feel we can, you know, we could take advantage of it, because we might look at it sooner than companies that aren't doing the same type of boots on the ground research that we are.
Great. The last thing I'll add to your talk, Damian, is you mentioned pent up demand that's created during the pandemic, and we did see that. If we look at history tells us that there was obviously a lot of pent up demand during the Spanish flu, because after that was over, people just got bug wild. I mean,
that's a great term for you. That's exactly what happened.
Yeah, we got the roaring 20s, and women, you can appreciate that. Fashion went to the next level. Even us dudes were dressing nice. You know, we left the overalls and went to the the cool, I don't know, suits or whatever we were wearing back in the day. You know, and so we had the Industrial Revolution. You know, I think GM during that decade of the roaring 20s averaged a 50% annual rate of return, something crazy like that. So what's interesting is, coming out of this pandemic, we see a similar parallel here. You know, there's a lot of pent up demand. I've spoken with you guys during our reviews this year, and this first couple months of this year, and having these conversations with you, our clients. I know you're going stir crazy. You know, you're stuck at home with your spouse, you know, and there's no buffer. Everybody wants to get out and do some things. I mean, for Pete's sake, you're retired. You want to see the world and so forth. So it's something to be said about that pent-up demand. So we think that the economy is going to come back with a boom, providing we have a good solution for this for the COVID-19. So we see bright roads ahead of us. Well, again, Damian, thank you so much. You're awesome as usual. If you hold on for a while, Damian, so you can meet our two newest team members as well. Okay.
Absolutely.
Our first newest team member, we added to our team in January. They both actually started the first week of January. Is Jennifer Mitsutani. I have actually known Jennifer, I'm going to say 6-7 years now. Her father was a client of ours. He passed away last year. Great man, and a retired government worker. And Jennifer, I'll let her tell you a little bit about herself. She's extremely bright, and she checked all of our boxes. So with that, I'm going to have Jennifer come on and show her smiling face, and so you can see, put a face with a name when you speak with her on the phone. She'll tell you a little bit about herself and the areas that she's here to support you with. Okay, with that, Jennifer.
Hi, my name is Jennifer. I'm really excited to join such an experienced and awesome team. As you know, Rod is such a compassionate and very intelligent person. So it was really no question when he asked me to join the team and help offer some support to our clients that I was definitely up for that challenge to learn more and offer support to our clients. As he mentioned, my dad was one of his clients. So my dad retired from the post office after 28 years of service. So I kind of was already familiar a little bit with that process, just because I had to help him along with that retirement process, and also kind of joined him on his meetings with Rod just to kind of help him out and just know more about my dad's needs financially and going into retirement. So it's really exciting to join the team and kind of, help out other clients in the same situation. And I think it's a really important resource that we should utilize. So I definitely have a soft spot in my heart for, the postal employees that we service. So definitely don't hesitate to reach out to me if you need anything, have any questions. I'm definitely here to offer any support and guidance. A little bit about myself. I graduated from UC Irvine, so just down the street from our office. I graduated with a background actually in law and women's studies, but I also worked in real estate, so have a little bit of experience in finances. So right now I'm kind of taking my exams and learning more under the mentorship of Rod. So definitely look forward to adding more support to the team. I guess a little bit more personal about myself. I love plants. I enjoy gardening a lot during my free times. I think it's a really kind of just relaxing thing to do. I'm also into sports. I grew up playing basketball, so me and Rod kind of connect there. But yeah, after the pandemic, I look forward to traveling again and going out to restaurants. I love to eat and cook food. So, yep, that's a little bit about myself. And I really look forward to meeting everyone in person eventually.
All right, great, Jennifer, great. Jennifer also, her and her fiance or boyfriend, they have a dog. What's your dog's name, Jennifer? What kind of dog do you have?
Flo.
Pardon?
Flo. Her name is Flo.
Flo.
And I actually also have 2 bearded dragons.
Oh, I didn't know about the bearded dragon. So
Yeah, we have a boy and a girl. So we're hoping they'll have babies this year.
Oh, wow, wonderful. All right. Well, we just would like you guys to give a nice virtual hand in welcoming Jennifer to the Advanced Planning Wealth Management Group. She's very sharp. She's a quick learner. As she stated, she helped her dad through the retirement process. In fact, she attended the consult meetings with Jan and then the meeting with me as we walked him through his retirement. So she's very familiar with the government benefits package. Okay. So again, Jen, we're so excited to have you a part of this group. Now our next team member comes to us from Cal State Fullerton, and his name is Scott Wyatt. I love that name, Wyatt. It reminds me of the old Western days with Wyatt Earp and Doc Holliday. One of my favorite movies is Tombstone. Okay, and so that's what Kirk Douglas and Val Kilmer, who does a wonderful job with the Doc Holliday. And I love that one scene where he says, "I'll be your Huckleberry." So anyways, I regress a little bit. Wyatt is not a cowboy at all, and unless he just didn't tell us about that part. But anyways, Wyatt joined us on the same day that Jennifer did. And I will, at this time, turn it over to Wyatt so he can tell you firsthand a little bit about himself. With that, Wyatt, you're on the floor.
Well, hey folks, my name is Wyatt. As Rod said, I am a recent graduate from Cal State Fullerton. Graduated just this past year during the pandemic, so got to do lots of online learning and virtual graduation. I've pretty much been in Orange County for the last 20 years. I grew up down south in Louisiana, right outside of New Orleans. So more or less been out here in California for most of my life now. For the most part, I really enjoy cooking. So I do a lot of baking when I'm at home. If you have any good cake recipes, be sure to pass them my way. I think I ate about a cake a week for a couple months here during the pandemic. I'm also like Jennifer, I have a couple pets at home as well. I like plants. Pretty all-around guy. If you give a call to the office, I'll probably be the front line of defense here. So be fielding any questions I can answer for you and trying to help you out the best I can.
All right, great. Maybe once you like tell them a little bit about your was it you've been a competitive dancer, Scott, and I mean it's a real deal. I mean on a pretty high level. Travel to, was it Europe or somewhere to compete?
I was I guess you could say, professional Polynesian dancer for a while. Have a couple of real close family friends here in Costa Mesa who have their own dance studio. And with them, I danced for about a decade before the pandemic hit, but I was able to travel to Japan and Tahiti to dance competitively and dance in shows.
Awesome, awesome. Well, Wyatt brings a lot to the table. His personality, again, very bright. We went through our interview process for about 6 months, and we fielded over 500 applicants, and we tested several. We narrowed it down to the top 10 or 12, and we took the top 5, and it yielded these 2 young people. And we're very excited. We feel they bring a lot to the table. The whole purpose of this is to invest in you, our clients, so we can be even more responsive to your investment and government benefits needs. So we appreciate you. I know you know that, but we just can't say it enough. And this concludes this edition of Money Talks. And coming up next month, we have a great featured speaker, Diane Terrarico from the Franklin Templeton Funds, and she will be presenting their firm's outlook for 2021 with some other really, really good stuff. And then coming down the line, we're going to have some basic options training or tutorials for those of you that are interested in adding options to your portfolio. It's important that you understand options, at least the basics to options. So we will be covering some option basics. We'll have some Zoom meetings to go over that stuff with you. So we have a lot of exciting things lined up for you this year. And hopefully we'll be able to see your smiling faces in person at an event later this year. But until then, we're going to continue to come to you virtually with content that we feel will bring value to you. So with that, so long for now. Those that have not had their reviews for the year, their semi-annual review for 2021, you will be receiving a call from one of our team members shortly to get you scheduled through March. Okay. All right. Look forward to talking to you soon. If you have any questions after hearing this information, don't hesitate to call the office. Okay. All right. Bye-bye for now.